Multinational corporations rely on high-velocity capital streams to manage global operations, often funneling these flows through a single centralized treasury hub. To attract this business, Hong Kong offers qualifying corporate treasury centers, or QCTCs, a 50% reduction in profits tax, lowering the effective rate from 16.5% to 8.25%. But the system contains a contradiction. Many corporations find that the strict anti-tax avoidance safeguards meant to protect the tax base actually prevent them from utilizing the concession. The Financial Services and the Treasury Bureau and the Inland Revenue Department have identified this friction as a primary barrier to growth. Their 2026 public consultation proposes a two-tier overhaul to the tax code, designed to refine the existing rules and introduce a new lane for high-volume centers. The challenge for regulators is to facilitate centralized treasury operations without creating new opportunities for base erosion. This network represents the typical architecture of a multinational group. At the center is the QCTC, surrounded by overseas lenders, local associates, and non-treasury units. Ideally, capital moves smoothly between these nodes to optimize liquidity. In practice, current regulations create significant friction. There are 4 specific areas where rigid structural requirements treat standard corporate financing as if it were a tax avoidance scheme. To understand the 2026 proposal, we need to analyze these 4 points and the specific legislative patches designed to resolve them. The first friction point involves the dedicated CTC and safe harbor rules. To qualify for the 8.25% rate, 75% of assets and profits must come solely from treasury activities. If other business lines are managed here, the entity loses its status. This forces groups to maintain isolated, standalone entities, which increases administrative costs and prevents operational integration. There is also a penalty on local deposits. When a Hong Kong associate deposits funds into a local QCTC, the resulting interest income is fully taxed at 16.5%. However, if that same associate sends the money to an external bank or an overseas treasury center, that interest is often tax-free. The current code effectively incentivizes local corporations to move their cash out of Hong Kong rather than into a local treasury hub. On the outbound side, corporations face the subject to tax condition. A QCTC can only deduct interest expenses paid to an overseas associate if that associate is actively paying tax in its home jurisdiction during that specific period. If the lender has a net loss year and pays 0 cash tax, the Hong Kong QCTC immediately loses its right to the deduction. Finally, the anti-tax arbitrage rule limits deductions for the group. When a local associate pays service fees to the QCTC, the Inland Revenue Department caps the deduction to prevent the group from shifting profits from a 16.5% bracket to an 8.25% bracket. These combined constraints create a rigid framework that prevents groups from managing capital with the flexibility required for a global treasury. The government's proposed Tier 1 regime introduces a series of refinements that will apply to all existing treasury centers. Tier 1 directly addresses the outbound borrowing friction. Under the new rules, deductions are no longer permanently forfeited if the overseas lender is in a loss position. Instead, they are deferred and claimed later. The proposal also expands the scope of covered activities. In-house factoring, cash forecasting, and pooling now explicitly qualify for the tax concession. Furthermore, arbitrary transaction minimums will be replaced with a more flexible assessment based on the specific facts and circumstances of the business. These patches fix the most obvious flaws in the current system, but a more significant shift is proposed for larger operations. Tier 2 introduces a pre-approval lane for corporations that demonstrate significant economic substance in Hong Kong. Entry requires a minimum annual turnover of $100 million, at least 6 associates, and a local operating expenditure of at least $4 million. To encourage continuous growth, these thresholds for spending and professional staffing increase upon renewal. The trade-off for these benefits is a requirement for strict financial transparency. Corporations must maintain separate bank accounts and undergo separate certified audits for their treasury business. For those NIAN criteria, structural barriers are removed. The safe harbor rule is eliminated, allowing them to mix treasury and non-treasury operations in a single entity. Local associates also receive a 50% interest exemption, removing the penalty for keeping cash in Hong Kong. The rigid subject to tax and anti-tax arbitrage conditions are also removed. Instead of these complex rules, interest deductions are simply capped at 30% of EBITDA, a standard measure of earnings. By substituting rigid In this revised model, capital moves between local and global entities without the tax frictions that previously hindered the system. The framework shifts the regulatory focus from structural restriction to verified transparency. This plan is currently in the consultation phase, with legislative amendments expected to reach the Legislative Council in the first half of 2027. If passed, these changes will replace a set of defensive, restrictive rules with a framework designed for administrative clarity. The 2026 proposal marks a change in how Hong Kong manages treasury centers, moving away from arbitrary structural limits and toward a model based on local operations and staffing. The adoption of the 30% EBITDA cap for deductions also brings Hong Kong into closer alignment with international standards for preventing base erosion. By addressing these specific administrative hurdles, the government aims to strengthen Hong Kong's position as a hub for multinational groups that currently prioritize offshore jurisdictions. Ultimately, a competitive tax rate only provides value if the regulatory system allows corporations to actually use it. This new regime is designed to ensure the system works as intended.